Imagine opening your phone, scrolling through a US stock trading app, and realizing something that almost feels impossible. Right next to famous companies worth hundreds of dollars per share, there are real American businesses trading for just around $3, not 300, not 30, just 3. For most people, this instantly triggers one question: how is this even possible? And the next question comes even faster: is this a hidden opportunity or a dangerous trap? Most investors are taught from day one that the US stock market is expensive, competitive, and dominated by big money. They believe you need large capital to participate, that serious investing is only for people who can afford blue-chip stocks and long-term portfolios. But the truth is, beneath the surface of Wall Street, there exists a completely different world, a world of low-priced stocks where entry feels easy, where anyone can own hundreds of shares with a small amount of money, and where emotions often move faster than logic. This is the part of the market that attracts beginners, risk-takers, and dreamers. Because when a stock costs around $3, the math feels simple. If it goes to 6, your money doubles. If it reaches 10, it feels life-changing. That psychological appeal is powerful, and it's exactly why millions of retail investors are drawn toward these low-priced US stocks every single year. But what most people don't realize is that behind those small price tags are big stories of struggling businesses, turnaround attempts, failed hype, aggressive dilution, and sometimes unexpected comebacks. In this video, we are going to slow everything down and look at this world clearly. We're going to understand what it really means when a company's stock trades around $3. We'll break the illusion that cheap automatically means undervalued, and we'll expose why many of these stocks fall into this price range in the first place. Some of them are here because of bad management decisions, some because of brutal market conditions, and some because investors simply lost patience. By the end of this video, you won't just see these stocks as cheap shares. You will understand the psychology behind them, the risks that most people ignore, and the reasons why experienced traders approach this space very differently than beginners. Whether you're curious, cautious, or already tempted by low-priced US stocks, this video will give you the clarity most people never get before clicking the buy button. So stay with me, because what looks like a $3 opportunity can either teach you one of the best lessons in investing or one of the most expensive mistakes you'll ever make. Imagine opening your phone, scrolling through a US stock trading app, and suddenly stopping in disbelief. Right next to famous companies trading at hundreds of dollars per share, you see real US-listed businesses trading for just around $3. Not 300, not 30, just 3. For many people, that moment feels like discovering a secret door into Wall Street, one that was never meant for ordinary investors. At first, it feels exciting, almost empowering. Because when a stock costs around $3, it feels accessible. It feels like opportunity. You don't need a huge bank balance. You don't need years of experience. You feel like you can finally participate in the US stock market. But almost immediately another question creeps in. Why is this stock so cheap? And more importantly, what am I missing? Most people are taught that the US stock market rewards patience, discipline, and long-term thinking. They hear stories about blue-chip stocks, index funds, and companies that compound wealth over decades. But beneath that polished surface exists another world, a fast, emotional, unpredictable corner of the market where prices are low, risks are high, and fortunes can change overnight. This is the world of $3 stocks. And today, we're going to understand this world clearly. Not through hype, not through promises, but through real examples, real numbers, and real lessons that most people learn the hard way. When a stock trades around $3, it usually didn't start there. In most cases, it fell there. One of the biggest reasons stocks end up in this range is collapsed expectations. Investors once believed these companies would grow faster, earn more, or dominate their industry. When reality didn't match those expectations, the stock price slowly bled downward. A perfect example of this pattern is Sundial Growers, a cannabis company listed in the US market. At different times, Sundial stock has traded around the $2 to $3 range, even lower in some periods. The cannabis industry was once marketed as the next gold rush. Investors poured money in, expecting explosive growth. But competition increased, profits stayed weak, and excitement faded. The stock price didn't crash in one day, it slowly collapsed as hope turned into disappointment. Yet, even after all that, sundial never disappears from investor discussions. Why? Because low-price stocks keep the dream alive. People believe that if the industry rebounds, if laws change, if profits improve, the stock could rise again. That belief alone keeps money flowing in. Another category of $3 stocks comes from small, innovation-driven companies that struggle to turn ideas into revenue. One such company is Zomedica, a veterinary healthcare firm whose stock is often traded between $1 and $3. On paper, the idea sounds strong: medical technology for animals. The problem wasn't the vision, it was execution. Product delays, weak sales, and unmet expectations crushed investor confidence. But here's what makes stocks like Zomedica dangerous and attractive at the same time. All it takes is one successful product, one strong earnings report, or one strategic partnership to reignite interest. And when a stock is already this cheap, even small improvements can cause sharp price movements. That's why traders watch these stocks closely, even when long-term investors stay away. Then there are cyclical stocks, companies that rise and fall based on global demand rather than company performance alone. Shipping companies are a perfect example. Castor Maritime, which operates cargo ships, has spent long periods trading around or below $3. When global trade slows, shipping rates collapse. When demand rises, profits can surge suddenly. The stock price follows that cycle aggressively. For investors, this creates confusion. One quarter looks promising. The next looks disastrous. Many people buy during the good times and panic sell during downturns, locking in losses. Castor Maritime shows how even a functioning business can remain stuck in penny stock territory simply because of industry volatility. Another reason stocks fall into the $3 zone is exposure to speculative sectors, especially cryptocurrency. SOS Limited is a company that is frequently traded near the $3 level or lower, largely due to its involvement in crypto mining and blockchain-related operations. When crypto prices rise, excitement returns. When crypto crashes, fear spreads instantly. Stocks like SOS don't move slowly. They spike fast and fall even faster. This attracts short-term traders who chase momentum, but it also traps beginners who confuse volatility with growth. Many people buy during hype phases and sell only after losses pile up. Then there are companies whose biggest problem isn't the market, it's dilution. Alt Alliance, another US-listed stock often seen between $1 and $3, operates across several sectors including technology and energy. But the constant issuance of new shares has repeatedly damaged investor trust. Every time new shares are issued, existing shareholders lose value. This is one of the most overlooked dangers of low-priced stocks. This is why experienced investors don't focus on price alone. They read financial filings. They check cash flow. They look for dilution history. Beginners, however, often focus only on how many shares they can buy. And that brings us to the biggest psychological trap. When a stock costs $3, buying 100 shares feels easy. Buying 500 shares feels exciting. Buying 1,000 shares feels powerful. The price does not equal value. Owning more shares of a weak company does not make it a strong investment. Another harsh truth is that $3 stocks are more vulnerable to manipulation. It takes less money to move their prices. Online rumors, misleading headlines, and sudden volume spikes can trigger emotional buying. By the time reality sets in, early buyers have already exited, and late buyers are left holding losses. That doesn't mean every $3 stock is a scam. Some are genuinely trying to survive. Some are rebuilding. Some are victims of bad timing or brutal industries. But the difference between success and failure lies in understanding why the stock is cheap. Is the company losing money every quarter? Is it drowning in debt? Is management constantly issuing new shares? Or is the business temporarily undervalued due to market conditions? Smart investors ask these questions before buying. Emotional investors ask them after losing money. The truth is uncomfortable but important. Low-price stocks are not shortcuts to wealth. They are tests of patience, research, and emotional control. Some investors make money here, but many more lose it chasing fast gains. If you treat $3 stocks like lottery tickets, they will teach you expensive lessons. If you treat them like businesses and study them deeply, they can teach you how markets really work. So the next time you see a US stock trading around $3, don't ask how many shares you can buy. Ask why the price is there in the first place. Because in the stock market, cheap prices often hide expensive mistakes. Before you close this video and return to your trading app, pause for a moment. Because the difference between people who survive the stock market and those who disappear isn't luck, it's understanding. A $3 stock can feel small, harmless, even exciting. But the market doesn't care about how small the number looks on your screen. It only cares about reality. Every low-price stock you've seen today represents real people, real decisions, real failures, and real attempts to survive. Some of these companies will never recover. Some will quietly fade away. And a very few may shock everyone by turning their story around. The problem is, most investors don't lose money because they chose the wrong stock. They lose money because they chose without understanding the risk. If you remember one thing from this video, let it be this: cheap does not mean safe. A low price does not protect you from loss. It only lowers the entry. And once you're inside, the rules are the same for everyone. Fear, greed, patience, and discipline decide the outcome. The stock market is not a place where money is printed easily. It's a place where money moves from the impatient to the patient, from the emotional to the disciplined, and from those who chase hype to those who study quietly. $3 stocks expose this truth faster than almost any other part of the market. So don't rush, don't chase, don't confuse hope with strategy. Learn first, understand second, invest last. And if this video helped you see the market a little more clearly, take that clarity with you, not just into your next trade, but into every decision you make as an investor. Because in the end, the goal isn't to get rich fast. The goal is to stay in the game long enough to win.